Now, for more, we're joined by Tony Ciero, Vice President and Senior Portfolio Manager at Caldwell Securities here in studio. Hi, Tony. How are you?
Pretty good, Mark. How about yourself?
I'm good, thank you. Let's start with Moderna, because this, of course, was a real darling during the pandemic for obvious reasons. That came up with one of the vaccines. But Bloomberg Intelligence's Sam Fazeli, he's saying this revenue guidance is shockingly low. So what's the problem at Moderna?
High input costs. Obviously, there's got to be quite a bit of cost-cutting measures. And basically, the demand for the vaccine is not as great as it once was. Our concern around COVID, again, is not as heightened as it once was. Let's go back 5 years ago when there was a rush to create a vaccine. It was Moderna, Pfizer, and I believe AstraZeneca out of the UK. And by 2021, when something was out there, Moderna was trading, I believe, over $4.40 at its high. And now it's trading at a fraction of that. It's sort of, if I relate it to IT, you need to have the next wave of vaccine or drug out there. And they have the next wave, but it's just taking too long and too costly to come to market. So in the short term, we don't see any positives coming out of Moderna. Cost-cutting measures and hopefully getting one of those next vaccines to market will potentially help them, but we don't see that happening anytime soon.
There's an analyst at Hedgeye Risk Management, and this may sound alarming, but he follows it and says this may go to zero. Does that sound a little crazy to say?
Any company can always have the propensity to go to zero. That would be crazy because that is a big pharmaceutical company, and if that were to happen, you're definitely looking at a shock in the S&P 500. So you'll see a lot of companies potentially get hurt if that were to happen. Government intervention. Sorry.
No, I was going to say that's just one person's opinion. I don't want to throw anything out there that's too crazy, but they did say that, and they don't like the stock, obviously. So let's look at what you do like. We're looking at Canada. You're looking for strong dividend growth, and you find that in some of the banks and Suncor as well.
Yeah, starting with the banks in Canada, if you look at the Royal Bank, CIBC, and the Bank of Montreal, those are the three banks we like a lot. Royal Bank has its propensity for growth. They've done quite well, and it's stable dividend, currently paying about 3.5%. And BMO and CIBC, actually CIBC did the best of the three last year. And if you couple it with looking at BMO and CIBC, now that loan loss provisions potentially come off the board with a decline in rates here in Canada, you can see revenues increase there. So we're quite optimistic CIBC will continue the trend and BMO will follow suit. And on top of that, you're getting a very healthy dividend, 4 to 4.5%.
And with BMO, are you sort of looking at the laggard effect as well, where oftentimes the laggards do well the next year?
Yeah, if you look at the BMO and couple that with Scotiabank and TD, BMO is a darling of the three. And you look at TD with all the issues they have down in the U.S., people can invest in that just because it's been depressed. But we think our outlook for BMO is a lot more rosy than it is for TD.
All right. In the U.S., some of the names you like are the biggest of the big, Microsoft, Amazon, J.P. Morgan. How come?
I'll start with the two, Microsoft and Amazon, and I've been on the episode talking about these two before. And both those companies have stable revenues from their core business. Amazon, largest e-commerce retailer platform, and Microsoft with its Office product suite and personal computing. But on top of that, it's their artificial intelligence capabilities and their cloud computing platforms that we really like. And we see that taking off eventually. There's a lot of costs in there. The fear of raising rates. These companies are very capital intensive. It becomes more expensive when rates rise to borrow against that. So that's why you see these companies coming off here because of the fear of rising rates. But long term, these are companies to hold because of that artificial intelligence capability.
And you also advise investors, Tony, to maybe have some low-cost ETFs, like broad exposure to SPY, which tracks the S&P 500. How do you incorporate that along with individual stocks into a portfolio?
And the reason why we do that for our clients is coverage. Last year, if you didn't hold the Magnificent Seven, in particular NVIDIA, your U.S. portion of your portfolio probably underperformed the S&P 500. But if you hold your individual stocks, couple that with a broad-based exchange-traded fund, you're closer to the index performance. So you get coverage. And will it be big tech names again this year in the S&P 500 or another area? You don't have to worry about that because you have coverage. We recommend a 2/3, 1/3 split. So 2/3 individual stocks and 1/3 the S&P 500 for coverage.
I see.
It also allows you to tactically shift. If you're not in favor of U.S. equities going forward, you can trim back your SPY position versus choosing which stock in my stock portfolio should I trim or sell. It's a lot easier to do that in an index than it is an individual security.
And you're also recommending exposure to some alternative assets,
Yes.
and you get that through the likes of Berkshire Hathaway and then Brookfield Business Partners. Why that one among all the Brookfield entities?
Well, Brookfield Business Partner was a spinoff of Brookfield Asset Management a few years ago, and they're focused solely on private equity investments. And we like them because of they're looking more at water scarcity, so big projects in Brazil. They're also looking at transportation and energy as well. So those are the three areas in the infrastructure space we really like. So that's why that reason. The other one, Berkshire, yeah, you can't bet against, sorry.
Mr. Buffett.
Thank you so much. And the reason, it's been so hard to beat the S&P 500 over a long period of time, say 10 years. But Berkshire Hathaway has a cumulative performance more than 20% better than the S&P 500 over the last 10 years. And they roughly have about 30-40% of their portfolio in private equity, and the remaining is in single stocks.
Right, and one day, and I don't mean to be negative or morose or anything, but one day we'll wake up and Mr. Buffett will not be around,
Yeah.
and they do have the succession plan, but that'll be quite a day. We don't look forward to it,
Yeah.
but it will come. Thanks so much, Tony.